So now let's turn to the upcoming inflation report that's coming out this week. So we have a pretty big deal here. This is going to be a very closely watched report. The June inflation report, the CPI as it's known, the Consumer Price Index. This release will come out this Wednesday, and economists are expecting a 3.1% increase in consumer prices year over year for the year ending, in June. That would be a significant decline from the 4% annual increase that we received in May. And so we continue to see this number drop year over year. And this is not surprising at all because we certainly have seen aggressive rate hikes by the Federal Reserve designed to deliver this kind of reduction in the CPI. So the estimate now as we look ahead for Wednesday is around 3.1% year over year. That's the number that many economists are looking at and saying, this is the number that we expect. Okay, so in essence, what this means for you as you're watching all of this transpire is that if the print or the reading comes in higher than 3.1%, right? If it comes in 3.5% or something like this, well, then that's going to be considered bearish. And you're going to hear people saying, well, the Fed's going to have to keep hiking rates. It's going to be higher for longer kind of thing. And it'll give the Fed the permission slip it needs to keep hiking rates higher. And it will certainly lead to a sell-off. And this week. So this week is going to be important for traders because we could have a big market moving week with earnings and with this CPI release. Of course, if we get a lower print, if it comes in, say, 2.9%, well, that's going to be a signal to Wall Street that the Fed has fewer interest rate hikes ahead, right? That the Fed doesn't really need to keep hiking. Remember, the economy is still processing these 10 consecutive interest rate hikes that the Fed has delivered over the last year or so. It's been historic tightening that we haven't seen in generations. So what's nice about that, you're saying, well, what's the benefit of that? Well, the benefit of that is that the Fed's going to have to unwind that tightening. And when the Fed unwinds that tightening, that drives prices higher, right? So we're in a really good place here, historically speaking, because you would rather be at the very end of a tightening cycle as an investor, getting ready to invest as they start cutting those rates, than you would be at the very beginning of a tightening cycle, as we were, at the beginning of 2022, right? So if you got to choose, you'd rather be at the beginning of a loosening cycle or this cycle where they untighten, the monetary policy, and that's where we are. But it's going to be dependent a lot upon what these numbers say. Now, the estimate again, 3.1% year over year. That's the number. That's the number you want to be focused upon. If that number is lower, it's bullish. If the number is higher, it's going to be bearish, right? So that's important for you to note. Here's a little note from which I thought was interesting from JP Morgan. They have said that they expect a 45% probability that CPI is going to come right in between that range, 3.0 to 3.2. Okay, that's what they're expecting. 45% probability, most likely outcome, JP Morgan has said. And they expect if that happens, that the S&P would rise about 0.5%, maybe 0.75% on that. Okay, there's a 25% probability, they say, that the CPI comes in between 2.8 and 2.9. Now, that's a very, very bullish scenario. That could lead to a 1.5 to 1.7% rally in the S&P 500, and it could cause the Fed to capitulate and do another hawkish skip, right? Since they would have seen inflation largely normalize before feeling the full effects of the tightening cycle. Okay, so there's a smaller chance that CPI will go below 3%. If that happens, that obviously will be bullish. They have a couple of other probabilities here just for kicks. A 15% probability that the CPI will be between 3.3 and 3.6. Now, that would cause the S&P to drop 1 to 1.25% underneath that outcome. That would be a bit of a surprise, obviously, with economists expecting a 3.1 print. There's a 10% chance that the CPI is 2%, 2.7% or lower. The S&P would rally big time, up to 3% if that were to happen. This would signal that the Fed is really at the end of its hiking cycle. There's a 5% probability that CPI comes in at 3.7% or higher. Now, that would cause a pretty big sell-off in the S&P 500. That would really be surprising, I think, to many, and it would cause people to sell because they would realize, wow, the Fed is going to have to keep raising rates. They can't get this CPI down. Okay, so those are things to keep in mind as we head into the CPI print coming out Wednesday. So it's coming out Wednesday morning, so be on the lookout for that. That will move the markets if it's not exactly 3.1, right? If it's above it or below it, that's going to be pretty interesting. So we'll be keeping our eyes on the CPI print coming this week.